All right. Hi, everyone. My name is PK, and here I have actually very grateful to have Jared Gracious. He is a keen property investor, and I'm really going to be leveraging his experience and skill in today talking about Phil Anderson's 18.6 year property cycle. You might have heard about this property cycle. It's a US phenomenon, and he's kind of translated it, Phil Anderson, an economist that is, into the Australian market. A lot of people talk about it. A lot of people talk about it accurately. A lot of people talk about it not accurately. Where are we on the cycle? Does it even have relevance in Australia? If we're at a good part of the cycle, does that mean we should just all be buying property, or are we at a good part of the cycle, but it's about to finish? Is the tide about to move away from the shore? Should we all be selling our property? These are the types of things that I requested Jared to come on and share. And so I'm really grateful, Jared, for you making the time.
Thanks, PK. Looking forward to a chat, mate.
Awesome, awesome. So let's just get started. And I must confess, I'm not as knowledgeable in this as I should be. So I'll be learning as I ask questions as well. And one thing that I'm really grateful for, Jared has an engineering background, so he's super number savvy, data savvy, so it's really good to talk to people who are not just like have a perspective on real estate, but have an educated perspective on real estate. So even though he's not an industry professional, he's not trying to sell you anything. He doesn't have anything to sell you in the property game. He's someone that we can all learn from. Welcome to the Oz Property Investment Mastery Podcast. My name's PK, and I help busy people build passive income by buying top 5% growth and positive cash flow property and build a portfolio using data without wasting months doing research, spending weekends at inspection or catching flights, or dropping $10,000 to $20,000 on buyer's agents every single time. So if you're confused, lack confidence, and just overwhelmed with all the information and marketing misinformation available online and don't know where to start, then this show is for you. So maybe my first question, Jared, if you don't mind, is maybe just start from the start and tell us who this Phil Anderson guy is. What is this cycle, and why should we even be bothered by it at all?
Yeah, that's a really good question because actually, I think one thing probably to address first of all is that there's a perception, or even yourself refer to it as the Phil Anderson property cycle, right? Now, Phil Anderson is certainly one of the leading experts and commentators on it, but we should recognize that Phil didn't invent the cycle. He wasn't the first person to discover the cycle, and he doesn't claim to be. And so a number of people and authors over the years have studied this concept of an 18-year real estate cycle. And Phil Anderson himself was inspired by a guy called Fred Harrison in the UK, who studied it and he published a book in the 1980s. And then Phil Anderson took that, ran with it, and went back and studied over 200 years of history in the United States. And so, whilst it's certainly Phil is a leading figure in the area, it's not necessarily the Phil Anderson cycle as I would refer to it. You know what I mean? Yeah.
Apologies. No, it makes sense.
No worries. You don't have to apologize to me. But yeah, so there is this concept that there is, I think people understand intuitively that markets do move in cycles. Markets move up, they move down, they move sideways. But this concept comes from the background of looking at, if you look at a long period of time, 150, 200 plus years, certainly in the United States, what appears to happen is that every 18 years or so, you get a peak in land speculation, followed by an economic downturn. And that's sort of the where this thesis or this economic hypothesis has been formed, and where there's a number of people who have studied it and have developed investment strategies and things around it. Does that make sense?
So it's before talking about real estate, is it right in saying that first and foremost it's actually an economic cycle? It's just the booms and busts of how the economy goes up, and goes down based on fiscal and monetary stimulus and unemployment and all that kind of thing. Is that kind of the root of where the theory
Yes,
comes from?
sort of. But the I guess the I'm trying to summarize it here, because if it's called the 18-year property cycle, that's probably good marketing, and it's short and it's sexy and it's punchy. But if you were to say what it really is, you would probably be more appropriately called like a study on the long waveform peaks of land speculation driven by capitalization of credit against land values led by the US market, or something like that, right? Like it is a more sophisticated economic hypothesis, and real estate is at the core of it, underlying land values, and specifically how the credit system and the banking system interacts with underlying land values.
Right.
Is that more confusing or?
For me, it makes sense, and
Yes.
maybe we'll get back to it in a second in terms of concepts like land speculation, which maybe
Sure.
people, or maybe just to clarify for everyone, what do you mean by land speculation?
Well, I guess speculation in land is the principle that you buy and hold land with the expectation that it will rise in value without actually, just by itself, without actually creating anything or developing it, just the land itself will rise in value. It's the same as speculation in anything else, whether you're speculating on Pokemon cards or Bitcoin or whatever. The speculation is the buying with the expectation that it will rise in value,
with no further utility added.
Certainly,
right?
Yeah.
Sure. And so economic cycles and land speculation cycles, now to hold that word, are a reality, whether it's in the US, whether it's in the UK, whether it's in developing countries, here in Australia. To what extent is this 18-year cycle applicable in Australia? Like, is the cycle duration different in different parts of the world?
Yeah, so okay, I think we can go into that, but and I've got some data that I think share with you and your audience to sort of show that. But what might be a good place to start on is just like an overview of what the cycle is, and then what we can do is we can try and, through that lens, maybe see and try and interpret it within the Australian market, because I think you touched on earlier that it's not explicitly an Australian cycle. It's led by the US as the world's biggest economy and the global reserve currency, but Australia does follow the cycle, but it manifests in different ways in different financial markets and different geographies. So that's a really pertinent question. But what's important is that we can sort of break it down into 4 phases of the real estate cycle. And when you're looking back over like 150, 200 plus years, like the cycles throughout those periods of time, like the economy and our lives and society has changed significantly. Like we're going back to a period of time where people are literally getting around in horse and carts, right? So the banking sector and economy, it looks completely differently. But through a study of those cycles, what we're looking for is there are certain things that happen at certain stages in the cycle which are the same. And that's kind of the underlying metrics that you can look for to kind of tell the time of the cycle. Does that make sense?
Makes sense.
Okay. So yes, there are basically 4 phases of the real estate cycle. So there's the first phase here, which is like the recovery or the first half of the cycle. We have a mid-cycle slowdown. We have the second half of the real estate cycle, or the boom phase, followed by the downturn or the bust phase. So at different stages, different things happen. And if we think about like the first phase of the real estate cycle, this is typically like after a GFC style event, so about like 2012 onwards. A number of things start to happen, because the first thing that starts to happen and that you see in the first half of the real estate cycle is that governments and policymakers and and banks, they tend to put in place protectionary measures to make sure that nothing like this can ever happen again, right? So you get things like banking royal commissions, you get things like the responsible lending laws being introduced, you get APRA interventions, because the memory of the GFC is still pretty fresh. And so, there's these things put in place in order to prevent that from happening. You think?
Sure, gotcha.
So then what happens is during the first phase, this is usually driven by new technology and innovation. And again, going back over 200 years, each cycle, the new technology and the innovation is different. So, through previous cycles, it was the invention of the popularization of the steam engine, and then railroads, and then telegraphs, and then we've got computers and internet and blockchain and, energy storage and all this exciting stuff. So the first half is characterized by that. And what we tend to get is about 7 years of rising land values, okay? Before we approach this mid-cycle slowdown period in the market. Now, the mid-cycle slowdown is typically where you get a stock market crash. But importantly, what differentiates it from the end of cycle is that this is not a land price-led downturn. And so because it's not a land price-led downturn, governments and policymakers and banks, they're able to manufacture our way through it with a relatively soft landing.
Right.
And so, in this period in the market, sometimes real estate goes down, sometimes it goes sideways and bumbles along, and sometimes it goes up. But it's importantly not a land price-led downturn. And so it doesn't tend to be a financial crisis.
So the way to interpret this and connect it with what you've just said is that in 2001, there was not really a land price-led downturn. There was the dot-com bubble was burst. So it was you could say it was a financial downturn, but not a real estate downturn. Is that the right understanding?
Well, I would call it a stock market crash, but the financial sector banks didn't go under, it wasn't a financial crisis in the same way that the GFC say was a global financial crisis.
Gotcha.
So that's correct. And look, recently we've sort of been going through this. We've had a stock market crash through the Corona crash, but real estate values around the world and in Australia have pretty much bumbled along a little bit and now have risen. And so that as well is one way it can be interpreted within the Australian real estate sector.
Because that's kind of always my beef with these types. Let me just play the devil's advocate for 1 second.
Go for it.
That's always my sort of beef with, with cycles and saying that there will be a point where there's a recovery phase and then there will be a mid-cycle hiccup. And then, my mind always says, well, like it's always different. And this time it's different. Like this time we've had this coronavirus-led economic, you could say downturn, although it wasn't really a downturn, because there was just so much stimulus pushed in. And even though the stock market has crashed maybe 3 times in the last 2 years, it's not really been like a 2001 crash, because every time it crashes within a month, it's back up to where it was or beyond. And certainly house prices haven't come down at all. So not only is there been no house price led crash, it's not even that because of a stock market crash that house prices have come down. Basically, nowhere in the world in the last 2 years have house prices come down. I could be wrong. There might be some random country, but do you know what I mean? So I'm like, my mind is always like, okay, well, it seems to fit the bill that there was a stock market rumble, but it was different this time because the housing market wasn't affected. Like, how do you think about all that in the context of this theory?
I mean, what you just said was a great way to summarize it. In the context of the cycle, that sort of validates at least the theory a little bit, in the sense that in a mid-cycle slowdown, we do expect a stock market crash, but by definition, it is not a land price-led downturn. And also by definition, it's different every cycle. The dot-com bust is different to this one. And whilst, we're looking at this stylized diagram, which is very pretty, and like, wouldn't it be nice if markets moved exactly like that? But no, they don't. And whilst what's important about this cycle is that whilst you can expect, a alarming regularity with which you can get the peak to peak or trough to trough things happening, the frequency is pretty reliable, but the amplitude of the cycle, it can change, and it depends on so many different factors. And notwithstanding that, the geography, so different market, some global economies still haven't recovered from the GFC, and Australia was in a blessed position at that point in time, being able to, being a budget surplus and being able to just shovel money into the housing sector to kind of prevent that downturn from happening. But the timing of it was quite reliable, which is why this is such a fascinating study.
Right. No, I think that's a great answer. That makes a ton of sense.
Okay, so where were we? We've gone through this phase. We go through about 7 years of rising land values. We have a bit of a hiccup here, and then we enter this phase of the cycle, and this is the second half, or where the big boom happens. And whilst the first half of the real estate cycle is characterized by new technology and innovation, the second half tends to be driven by massive government spending in infrastructure, massive building projects, and that sort of thing. And the other thing that happens after the mid-cycle slowdown is because we're able to kind of manufacture our way through it. Recently we've seen this, how governments have stimulated the economy, a lot of QE happening and things like that. We start to see an unraveling of the protectionary measures that were put in place after the last cycle. So this is also important because it allows the speculation and the run up and the bust to happen for the next one, because in Australia, we've had, the responsible lending laws, the Banking Royal Commission out of the way. Everyone's forgotten about that. We've had, APRA. They've basically come out and said that they're not going to touch the housing market anymore, or not going to interfere with the housing market. And so already banks are starting to ease their credit policies. And this is very characteristic of the cycle itself, right?
That's actually a great point, because just the other day, my mortgage broker was saying that even though interest rates are rising, a lot of the levers that banks use to assess serviceability, they're starting to loosen them up. Things like looking at bonus income and other things like that. So what you're saying is ringing true for sure.
Yeah, that's right. And it's in that way, we can start to see that unfolding and setting us up for this second half of the real estate cycle at the moment. There's your first clue, PK, about where we are. Okay, so then what tends to happen is, we get another run up into the peak, and typically the last couple of years of this run up, we start to see a lot of speculation. So it's no longer underpinned by fundamentals. Everyone's piling in, and again, 2005, 2007, that's where there was all those fraudulent mortgage bonds in the United States, and that cascaded through the world. We all know about that. We get the peak, and a number of things happen at the peak, and we can talk about indicators and how to tell the time if you like, followed by the downturn of about 4 years from peak to crash to recovery. So that's sort of the overview of the cycle, where you have basically 14 years up, punctuated by a mid-cycle slowdown, and then 4 years down, roughly speaking.
Right.
Is that a fairly good synopsis?
I think so. Yeah, that makes sense to me.
You asked a question about how it plays out within the Australian real estate sector. And I know you have a background as a stock market analyst, or
yeah, I was investment banking, covering oil and gas stocks.
Okay, so you might like this. One important thing, just to kind of a principle, because I think most of your audience is property investors.
Correct.
And they may not necessarily have like a technical analysis background or a share market background. But I think just in principle, a key thing is that, and this is something that I've learned from Phil Anderson. This is what he is very valuable at. The way he looks at the markets is that a lot of the value in the share market is capitalized against real estate or land values. So the financial sector, banks, depending on the bank, you might have 60 to 80% of their loan book is residential real estate. And even a lot of their business lending is capitalized against the balance sheet of the business, which is their main asset might be the land value. And then you have real estate investment trusts, you have builders, you have developers. So a lot of the share market is capitalized against real estate, which is why a land price downturn can cascade through everything and turn into a massive downturn.
Right. Which is what happened in 2007-8.
Correct. Now, this is an Australian stock called Stocklands. You probably know the company. They're a developer.
Yep.
And this period of time that I've pulled up here is from 1990 through to 2010 or so. And it basically captures the entire previous real estate cycle, right? That's quite a remarkable
Yeah, it
similarity,
is. It's pretty
right?
uncanny, isn't it?
It's amazing. So, you can look at this and you can see that, okay, the Stockland's a major developer in Australia, trades in the underlying land value is capitalized into their share price. And so you would expect to see this sort of shape. And you can see that from the previous cycle, yep, you sort of get about 7 or 8 years from the low of the previous cycle through to a peak, bit of a dip. And then after that, we go and break into new highs and we have a massive run up into 2007, followed by the downturn.
Right.
Now, okay, so this is only one stock. Here's the same chart, but I've just extrapolated it so that we get from the previous cycle and then through to where we are today. And so you can see that they're from the top, 2007 to this point here, 2011 was the last low that was put in, and so that's the 4 years down before the recovery. And then you can see again from there about 7, 8 years to the previous peak. We've had a stock market sell-off, and now we're expecting a recovery in this type of sector. Because Stockland's, look, that's only one company, right? And so I could have just picked that just to be persuasive, but the reason why that's a good one is because we can go back and we can actually look at the full previous cycle. A lot of listed companies don't necessarily go back for the full cycle, so you just can look at parts of it. But this one here, this is the SPDR ASX 200 listed property fund, and so basically this is an index which tracks the Australian property sector on the share market.
Sure.
A lot of REITs, developers, builders, that sort of thing. And again, you can see the same shape unfolding here. And yeah, you can see the previous peak, 4 years down from 2011, 2012. We had about 7 years up, mid-cycle blip, and we're expecting now the next sort of recovery into the next phase of the cycle.
It's very interesting that even though the real estate market has had a huge run up in the last couple of years, a more aggressive run up than even sort of up to 2007, that these REITs and the stock market and Stocklands, their price doesn't reflect it.
Yeah, I was thinking about that. That's a really good point, because I think also, we're talking about the difference between the residential real estate sector and then, the REITs and these sort of stocks are more, probably skewed more towards the commercial side as well.
Yeah.
And so a little bit different, but again, for telling the time and seeing the overall shape. And this is why, again, there's different sides to the real estate sector as well. Just residential prices can move differently to other sectors in the market.
Yeah. So
this one is a chart from SQM. So this is an aggregation of the Australian residential sector going back to 2009, 2010. And again, you see from a bottom in, say, 2011, 2012, we have about 7 years of rising land values, bit of a bumble along sideways through this period, followed by now the last 12 months where we've had a 30% growth year pretty much in Australia. And so this would be an indication that we're entering that second phase of the real estate cycle.
Right. It's hard to stomach. I mean, I know you're going to get to how we tell the time and things like that in a second, but it's really interesting to me because what this is suggesting is that we've gone through that little hiccup period and now we're in earnest starting that second phase of the real estate sector, real estate cycle.
Yeah.
It's hard to stomach it because we've already had such a run up, like you said, 30%. It's almost like everyone, including like a lot of people who, not just no ones, like they study this stuff as well. They think that the next year, the next 2 years is all about the property market coming down 20%, 30%, whatever, depends on who you talk to. But is what you're saying, and sorry, I might be putting the cart before the horse for a second again, but is what you're saying that we're really still early on in that second part of the real estate housing cycle?
That's my expectation, is that's where we are, is we're just coming out of that mid-cycle slowdown. Now, again, what happens in the next 12 months or 24 months is less significant than maybe what happens over the next 5 years, right? So yeah, the next 12 months, maybe it'll bumble along sideways. markets within markets. Certain markets are going to go off, certain markets might come down a bit. And that's also where, you know, your investment strategy becomes very important, because you're not just buying an index or whatever, right? So when you're investing in real estate. So
Yeah, no, makes sense. Makes sense.
Well, actually, no, you actually brought up a good point. Can I pivot this a little bit? Because, you know, you said that, you know, there's a lot of people saying that, hey, the market's going to come off the boil now. We've had a 30% growth. And so therefore, you know, we're due to have a little bit of a correction. And maybe, but historically, that's not necessarily been the case. And usually when you have those at this stage in the cycle, you can have a 30% growth year followed by, you know, several double-digit growth years. And so, you know, that's happened historically as well. And what's important for people to understand, I think, is people think, oh, well, house prices are so expensive. How can they go any higher? They just can't go any higher, right? But the housing market as a big picture thing is not necessarily driven by, you know, what you and I can afford. It's more about, well, what can what will the banks give us? And so we've already seen the recent federal election. Both parties came to the table promoting policies that are going to, you know, prop up the housing market. So there are a couple of things that I'm looking for that may be a bit scary towards the peak and could drive it much higher. So, you know, bank assessment rates coming down, that could be one thing. So, you know, if banks were assessing loans at 2% higher than the interest rate you're paying,
3%.
Well,
yeah.
3%. There you go.
Yeah.
Well, then interest rates can rise by 1 or 2%. But if the assessment rate drops by 2%, well, your borrowing capacity still rises in a rising interest rate environment. Okay, so that's one thing. You know, the government's now going to buy the house with you. They're going to pay 30%. You know, the Liberal Party was spruiking access to the superannuation. So if you're allowed to access superannuation to pay a deposit, that's something that's going to, again, funnel money into the real estate sector. If, you know, lower deposits used to be 20%, now 10% is the standard, 5% loans exist. Single families can get a 2% deposit. You know, if that becomes the norm, that could be another thing that drives it up. We've got interest-only loans for owner-occupiers could become common. You could have fractional ownership. Like, there's so many things and clever financial instruments that could prop up to just drive things higher and higher. That's not a prediction, but, you know, these are the sort of things that I'm just sort of keeping an ear out for.
One thing I wanted to ask you, because it's something that I haven't fully formed my own hypothesis on. You know, it's quite clear that housing affordability is pretty poor, like at least in, let's say, Melbourne, Sydney, you know, markets within markets, everything like that. But, you know, broad brush statement in Melbourne, Sydney, it's pretty poor. Even in Brisbane, it's getting pretty bad. And Hobart is pretty bad as well. Yet in other countries around the world and other major cities around the world, affordability is just as bad, if not worse. But prices, decade after decade, year after year, have continued to go up. You know, everyone knows London, Hong Kong, New York, et cetera, et cetera. My theory is that the property market no longer in these jurisdictions is no longer dictated by the average person. It's no longer the median person or like the average person who's on an income of whatever the average is these days, $80,000, $90,000. It is not that person that dictates the direction of the overall housing market, because we're living in a capitalistic society where, you know, those who, depending on how you see it, work hard or work smarter, or they just always had a leg up in life, you know, the richer getting richer and inequalities getting bigger. That's a fact. And so therefore there are more haves, and those more haves are able to buy more real estate or anything for that matter. And so therefore, as long as there's enough haves, as long as the top 10, 20% of society have enough wealth, they're able to create enough demand to further boost house prices. That's sort of how I think about places like New York, think places like Hong Kong, London. You know, the average person in London can't buy a house, so why is house
Yeah.
prices still rising? Um,
Yeah.
is that, what's your take on that? Is that why you think that Sydney is so expensive and is not really cooling down? I mean, yes, house prices going back a little bit, but it was so expensive 5 years ago. I remember after the last boom, 2016, people were like, yeah, damn, like no one can buy a property. Next thing you know,
Yeah.
5 years
Yeah.
later, it's like, you know, another 20, no, another 40, 50% up.
Precisely. Yeah.
What's your, do you agree or do you have a different view on my theory of how affordability is not the key factor of house prices?
That's a really interesting point. Like this is not
Also, I'll just
necessarily.
add one more thing as well.
Yeah. Go for it.
Sorry to cut you off. And I don't have the chart in front of me right now, but when you look at wages and you
Mm,
look at house prices going back 50 years, there's no correlation. Yeah, it's
mm.
not like when wages go up, house prices go up. You know, as a proportion, you know, that ratio of house price to wages has just been going exponentially through the roof. And so that means it's not wages that provide cap on house prices at all. So sorry, I just wanted to round that off.
Yeah, that's a really interesting point. I mean, that's a whole nother discussion topic on itself, but there's a couple of interesting things. Well, first of all, you named a number of like major international markets: New York, London, Hong Kong, Sydney.
Auckland, yeah.
Yeah, these are international hubs, and so they attract big international money, I think. And so probably more so than other markets, my personal view is that those markets are not driven by the average person who lives in them.
Mm.
But overall, I don't know how much that statement is true across the overall market, because those are some pretty specific, international markets that attract international big money into those places. But again, we already sort of touched on that before, that the housing market is what is driven is not by what you and I can afford with our wages. It's what the bank will give us.
Yes.
And so if the bank will allow us to pay, my parents bought a house when they first bought their first home. The mortgage, they had to pay a 20% deposit, and the mortgage was over 15 or 20 years, right? Now, if then your mortgage goes out to 30 years, the repayments are less, the interest rates come down, the deposits come less, you can afford more again. And so I think the innovation of financial products and things to facilitate higher and higher prices is part of it. It's probably a bigger part than wages, or certainly a bigger part than wages. And then the other thing is just how much that cascades and how it like snowballs, because when you have a little bit of money injected into the bottom of the market at the affordable end, let's say, then we saw this in the last GFC when the government put in money in first homeowner grants and building stimulus packages. What happens? Well, the lower end of the market gets a bump. The upgraders from there, they take that out. But let's say you have a 400K property that goes up to 450. Well, if you sell out and buy your next property, that 50K equity isn't just going to go into the next house. You're going to put it as a 10% deposit. And you're going to leverage it up, right? And so the next tier up gets a bigger boost, and then the next tier up gets a bigger boost. And so it just sort of fans the flames, and credit just sort of grows and grows like this. That's my take on what you're just saying. I don't know if that makes sense, or if it's aligned with what your view is.
Yeah, no, absolutely. And that's kind of a little bit similar to one thing that I had on my mind. And sorry, we'll come back to the cycle as well.
Yeah.
I'm just conscious of time as well. Is like, how in your mind has this 18-year cycle, Phil Anderson cycle, has it changed post 1970s? With the fiat currency and debt, becoming a big thing. It's almost like the central banks, especially post GFC, have kind of discovered magic, that we can solve any issues through quantitative easing. We can solve any issues through printing money. Of course, now we have an inflation problem. Let's see how long that lasts. Well, I personally don't think it's going to last very long at all. As soon as supply chain bottlenecks and Ukraine and things like that are sorted, I think it comes right back down. But does that allow the cycle to, just sustain itself longer and longer? And is there then a harder fall? Or do you have any view on that?
Yeah, so my understanding is that, you know, historically speaking, the cycle has been remarkably regular in terms of its frequency. You know, it's not exactly 18 years, but, you know, between 17 and 21 years, about 18 years on average is remarkably reliable. But the amplitude of the frequency is significantly variable. And so all of these things, I think, fan the flames and could potentially, we have to see how it plays out, could potentially lead to bigger booms and bigger busts. But, you know, and at the moment we're seeing a lot of QE, but like that might not be necessarily possible at the end of cycle crash, because if it's underpinned by a major land price downturn, then, you know, there might be currency issues and reasons why central banks can't just keep pumping money into the economy. So without stimulating, you know, massive inflation. And so that's the primary role of central banks, right, is to preserve the currency. And so that could also be a factor at the end of cycle, as opposed to where we are at the moment, where they can just, you know, print more and more and more money to get us through where we're at.
Yeah. All right, Jared, was there anything else that that you wanted to share about the cycle? Any other insights or any other pointers that you think are interesting and people should know about?
Well, one thing that I did want to share was probably just like an indicator that we can use to kind of time the top of the market, because that's what it's all about. And then actually the only thing we haven't really talked about, I'm not sure how you're going for time, but, you know, in terms of actually investing, you know, we've talked about this cycle as a theory, but it's not necessarily an investment strategy, is it? You know, so I don't know how much you want to go into that, or if we can leave that for another time. What I've got here is yield curve. Now, I'm sure you are familiar with this, PK, but this is essentially the difference between the US Treasury bonds, between the 10-year bond and the 3-month bond. And this is going back to, you know, the 1980s. But what we're looking for here is that when there's an inversion of the yield curve, what tends to happen is within sort of about 6 to 18 months afterwards, we enter a recessionary period. And so we can see that happened at the end of the 80s, followed by the 90s recession. Again, early 2000s, we had a yield curve inversion, followed by the dot-com bust and recession here. This inverted in 2006. So again, you could have been sort of forewarned ahead of the GFC style recession. And then again, we had in 2019, we had a yield curve inversion on this chart, which this is before coronavirus was in the public domain and a big news story, right? So there was already going to be, you could be on the lookout for something to happen. Of course, the yield curve doesn't necessarily tell you the difference between the mid-cycle and the end of cycle, but it's something to look out for, as well as other indicators. You're looking in tops in, you know, REITs and developers and things like that. If they start to top out and then fall, then, you know, you can use those metrics to kind of see where we are and what's coming ahead.
Gotcha.
That was the only thing other thing I really wanted to share with you.
Yeah, no, that's very interesting, because it's impossible to perfectly time anything. And to kind of pick up that point that you were also referring to before, knowing about the cycle or any cycle is super interesting. And I think property investors owe it to themselves to get as educated as possible. But like you were saying, this is not an investment strategy. It's not that we should be buying at a particular type of part of the cycle and then selling at a particular part of the cycle. I mean, I always say that time in the market is very important. And I always say that timing the market is very important. A lot of people say time in the market is, you know, very important, and timing the market, it's like, oh, whatevs. But I categorically disagree, because you can time the market so bad that you will never buy real estate ever again. So timing is very, very important. But having said that, timing the market is not a strategy either, because you can't do it perfectly every single time. And even within Australia, I mean, Jared, you know this as well as I do, and I want everyone to know this as well. Even though there's this cycle and it suggests that we're still in this phase of, I don't know, maybe 5-6 years of continued growth, before there's a huge fall or a fail or whatever there's going to be. There's always markets within markets. And so can macroeconomic commentary predict what's going to happen on one street in the south side of Brisbane or in one house on one cul-de-sac on the north side of Perth? No, it can't. It can only talk aggregates, right? Just like when there's a recession, a lot of people become unemployed, but a lot of people also get pay rises. There's always exceptions to the rules. So it's a really good point that you made before, Jared, that none of this is an investment strategy, but rather it's more intel for you to be able to most intelligently implement your investment strategy. That's the way I think about it.
I love the way you just said that. That's exactly the way I like to think about it, is that, you know, you have the macro view, the big picture, the long wave form things and what's happening in the global markets. Then you have the macro, the meso, and the micro. And so then as an investor, you increase your resolution of focus as you dial in on not only the shorter time frames, but also the specific geographical areas which you're investing in. And so I think this is the cycle. This is the macro. This is the big picture stuff. Then you got to look at the Australian market and where that's at and what's happening at a meso level in the middle. And then you zoom really in, and then you understand the individual suburbs and the geographical areas and which streets and what's happening and what's supply and demand looking like, and different metrics at the micro level. And I think, you know, you need to layer those together to be a sophisticated investor. And I think that's certainly what I aspire to do. Yeah.
Yeah, no, same. And we were talking about this before we started hitting record. You know, if there's anyone who's a property guru, much like me, who's saying, oh, well, we're starting at this cycle of huge gains in real estate, you guys should buy, it's a fantastic time to buy, just switch off that video and unsubscribe, because like that is not good advice. You know, we could be starting a cycle, we could be ending a cycle. There's always good opportunities in real estate. There's always bad opportunities to invest in real estate as well. At the end of the day, and this is my personal way that I find properties and invest myself, I actually start bottom up. So, you know, I like that example of like creating higher and higher resolution as you go closer and closer. Yes. I like to start with the highest resolution, finding a really good pocket of a suburb that the data looks really incredible for, and then zooming out and saying, oh, how does the overall suburb look? Like, is there any red flags there? Okay, zoom out. Is there anything that seems a bit sus about that local government area? And then the city, then the state. And it's like, oh, hang on, are we about to enter a war with China? Maybe I shouldn't invest. Or if there's no war with China, I'm going to go and invest in that one house and that one cul-de-sac. That's how I do it, because if you go, this is completely different to what everyone else thinks and talks about. If you go top down, like, how do you ultimately get to a location? You know, Queensland's a great place to invest. Is it? There's good places, bad places. Like, how do you make any intelligent decisions from that? That's just me. Probably everyone's different, but it's important to look at the macro. It's important to understand the cycles, but don't lose sight of what's important, which is just being able to buy that one house, because that's all that you can buy. Exactly. Yeah. Jared, anything else that you wanted to share? And I just want to thank you as well, because you're a wealth of knowledge. But is there any other insights or anything else that you wanted to share lastly? No, mate, thanks. I think we've covered quite a lot of ground in this. So hopefully that's of some use and provides a little bit of perspective maybe on it. I know I'm getting the sense there's a lot of, you know, increasing awareness of this concept of the 18-year cycle, but and there are certainly, sophisticated investors who really understand this stuff and have sophisticated plans and strategies for trading it and investing in it. But yeah, I think also there are people that just have maybe watched a YouTube video or read a blog post or something, and it's pretty confusing. So maybe that's provided a little bit of perspective. Totally. It has for me. I've kind of learned a bit. So thank you for demystifying it, Jared. I appreciate it a lot. Pleasure. Thanks, PK.